Hello, this is Jim Ammerman, Managing Director of Wealth Planning at Fortress Wealth Management. And in this lesson, we're going to discuss how your true future marginal tax rates can be much higher than what your tax brackets would indicate. So this is a very important metric, your future tax rates, because you want to minimize your lifetime tax liabilities and make prudent decisions on whether you should contribute to a Roth 401k or IRA versus a traditional 401k or IRA. And you want to make sure that Roth conversion decisions are going to work out in your favor, how much you should convert, what year to convert, things like that. Most people assume that they will have lower tax rates in retirement once their wages and earnings have ended. And yes, they may have less income in retirement, but their true tax rate can be affected by other levers in their tax profile. And one of the key levers for many people is Social Security benefit taxation. And another one is capital gains taxation. So I'm going to show you an example where those two levers apply, and the true marginal tax rate in retirement is almost 5 times the tax rate that the subject would probably expect to be in their retirement. So to understand how this occurs, let's look at Social Security benefit taxation calculations. So we'll start out on the right here, combined income. That's how we determine how much of the Social Security is taxable. So that's going to equal adjusted gross income plus non-taxable interest. So we're adding back muni bond interest, and half of your Social Security benefits are added to. And then going back to the left here, so the portion of this combined income between 32 and 44,000 is 50% taxable. It's 25 to 34,000 for single filing. And then above that 44,000 cutoff, then the combined income is 85% taxable. Then there's a limit, no more than 85% of the total Social Security benefit can be taxed. So this is confusing, I realize. With this chart below, maybe we can shed some light on this. So let's say that before adding Social Security, assume that there's 20,000 of adjusted gross income. So that could be interest, pensions, rental income, capital gains, etc. And then there's going to be 50,000 of Social Security on top of that. We're going to divide the Social Security by 2, so that's 25,000. And then we're going to add that 20,000 of AGI. So you get 45,000 of combined income. So the first 32,000 of that is not taxed. And then between 32 and 44,000 for jointly filing, 6,000 of that is going to be taxed. We take half of that 12,000 gap. And then any remainder above 44,000, 85% of that becomes taxable. So there was only 1,000 remaining. 45 minus 44 is 1,000. 85% of that's 850. So we add the 850 to the 6,000, we get 6,850. That's how much of the Social Security is taxed. Out of the total 50,000 of Social Security, only 6,850 is taxed. That's going to be at the applicable rate for their taxable income. In this scenario, it's going to be at a 10% federal rate. And if we look at another scenario where we're adding required minimum distributions, so at age 72, you have to start pulling funds out of your retirement accounts, whether you want to or not. It starts out a little less than 4% of the total balance, and then that percentage grows each year. So if we add that 42,000 to the 20,000 we had over here on the left, we have 62,000 total AGI before Social Security. We're going to do the same formula, 25,000 plus that gives us 87,000 combined income. So looking below, same thing in the first two categories, but now we have a much higher combined income total. So there's a lot more taxation of the Social Security benefit. So the total of 42,550, we take that and compare it to 85% of the total Social Security benefit. which is 42,500, and we take the lower of the two. In this case, it's 42,500. So this is a much higher number than 6,850. That's because this additional 42,000 up here pushed the Social Security into the taxable, high taxable area, this peach area here. So now we add this 42,500 to the 62,000 above the AGI before Social Security, and that gives us our final adjusted gross income at 104,500. It's a lot less over here because so little of this Social Security is taxed. If they're doing the standard deduction, we can subtract that, and then we have taxable income here. Over here, it's much higher. And the gap, the difference between the two is 77,650. That's a large gap, and it's much larger than the amount of income that was added in this scenario on the right. It's only 42,000 of income added, but it created 77,000 of taxable income increase. So the reason for that is the Social Security. More of it is taxable. Went from 6,850 to 42,500. So 35,650 increase. If we look at the actual tax increase, it's in the 10% and the 12% bracket, and it's about $9,000 of additional tax. If we divide that by the 42,000 required minimum distribution, which was the income increase, it's a 21.3% tax rate. So that's the true marginal tax rate. One would have expected to only be taxed at 10% and 12%, but instead it's almost twice that in this case. Most of the 12% bracket is scheduled to go up to 15%, if not higher, in 2026, when the current tax laws expire. The Tax Cuts and Jobs Act, TCJA, expires in 2025. And we go back to the tax rates we had before that, which were higher. And if you're looking at your retirement tax rates and you're thinking you're in the 12%, well, it's probably going to be 15%. And that's going to mean that we're looking at a 27% true marginal tax rate if the Social Security phenomenon applies to you. And if you combine capital gains phasing in also, then we can have this 55.5% rate. So if you have, say, just $1 of RMD, and that's in the 15% bracket, and it causes an additional dollar long-term capital gains to become taxable, you're pushing those capital gains into the region where it's taxable, then you have $2 of additional combined income. And that may cause more taxation on the Social Security benefit. So 85 cents could be applied for each of those $2. It looks like this. Here's the RMD tax, and that's the only income you're adding, but it triggers more cap gains to be taxable. It triggers more tax on the Social Security benefit, and that ends up with a total tax of 55.5 cents. So your true marginal rate is that 55.5 cents divided by the $1 of RMD that was added up here. We also have $28 trillion in US debt, so 55.5% may not be even the highest true rate you could be looking at if rates go up even more. So why this is important, a couple in the 24% bracket now, which could be 350,000 of AGI, probably doesn't think they need to look at Roth strategies if they know they're going to have significantly less income in retirement. But as we've seen, that can be not the case, and they could be looking at much higher rates. It's just a matter of making sure you're doing a prudent, careful financial planning projection, with a CPA that understands the software and is experienced in these types of analysis. So, choosing between a Roth 401k versus a traditional 401k, or IRA, that's a big decision that can mean a huge difference in your lifetime tax liability. When you make those decisions accurately every year, whether you should do a Roth conversion or not, how much, what year, backdoor, make a backdoor, applying those, which we may not have after 2021. We'll see if that's still available when the new tax laws get passed. But you want to take advantage of them this year if you can. Some of the other levers that can increase your marginal rate, Medicare premiums. So as you have more income, you can end up paying higher premiums. The Medicare surtax and net investment income tax, that gets applied once you're over 200 and 250,000 AGI, the qualified business income deduction. Those are just a few, there's more. So bottom line is you want to make sure that you're being careful about mapping out your future tax calculations and liabilities, and that should determine what tax strategies make the most sense for your current situation. So if you have any questions, or if you would like a free customized assessment on your situation, feel free to send me an email to jim@fortress-wealth.com. And thank you for your time.